Welcome to Achieve Wealth through value-add real estate investing. This is the show where the guru hype is banned and you get direct insights from commercial real estate operators. If you're a passive investor, this show can help you better understand investment opportunities. And if you're an active investor, the lessons from each episode can help you to become more effective in your own deals. Now, here's your host, investor and author, James Kandasamy.
Hey audience and listeners, this is James Kandasamy from Achieve Wealth through value-add real estate investing. I'm here today with Mark Kenney, who's the founder and I'm not sure if there's president or what's the title there.
Yeah, my wife and I together, so she might have different opinion.
Okay. But both of you runs the thing multifamily. Yeah. But before that, before we go into the hot topics that we're going to discuss with Mark, make sure that you guys look at last week's episode where we had KK Singh being interviewed. KK has moved from a business owner. He used to own gas stations, laundromat, and now has become a multifamily investor, which is a very, very interesting concept because I think any business owner or anybody who want to know how that business is run and why is he using multifamily, why did he go into multifamily, and he didn't even pay tax last year just because of the multifamily investment. So you guys want to check out the last episode. But let's come back to this episode. Hey, Mark, welcome to the show.
Thanks for having me, James. Great to see you again.
Awesome. Happy to have you on the show. So Mark is he's a GP. He's almost like 5,200 units, where out of that 2,000 units, where he's basically the primary active asset manager, and he's also GP on another 3,200 on top of the 2,000 units, and he goes across multiple markets, which is very interesting for me. I want to go a bit deep dive into that. He's in Texas, he's in Alabama, he's in Tennessee, he's in Florida. And I believe that's what I covered, right, Mark?
Georgia as well.
Georgia. Yes. Okay, got it. Atlanta, right? So did I miss out something that you want to, about yourself? Do you want to tell our audience about yourself?
No, real quick. So I grew up in Michigan. I'm in Dallas now. So not too far away from you, James.
Absolutely.
But I was a CPA for a while, did IT consulting, which you and I traded some stories about that before, about the IT side. And I started buying small multifamily when I was 22. I was a senior in college, but 2 to 4 units. And then my brother and I didn't know what syndication was. Syndication is the fancy word for raising money from other people for the most part and pooling it together to buy properties. I didn't know what that was. So I started buying 2 to 4 units. And then my IT business was doing pretty well. I really had no time. I was, I say 80, 85 hours a week, and start really doing the math. I was probably 90 to 100 hours a week on a lot of weeks. And, frankly, didn't have any time for my wife, caused some issues. And so she basically said, you need to do something different than what you're doing. And I said, well, yeah, I will, but, you're going to have to do it with me. And we both loved real estate. So we started buying larger properties through syndication. I invested passively first in the syndication with a friend of mine. Said it makes a lot of sense, and so I want to look at doing it myself, and that's what we started doing back in 2013.
Got it. It's very interesting about your story when you're working on a W-2 job, especially in the IT tech industry. It's a lot of work. We put in long hours, right? It's a constantly changing sector, right? The industry is consistently changing. We are always driven by schedule. And I was just talking to Shanti, who's my wife, on how our life has changed. When we used to be in W-2, every day, Friday is when our weekend really open up, our time open up. So Monday to Friday, we are so busy working, our time is focused. And where I used to work, we used to work remote as well. So after 5, 6 o'clock, we used to work we have lunch, we have dinner, and then we continue working with the offsite team. So life never ends. And now with real estate, is so much of difference. You own your own time, and you're able to decide on what to do. And we can, my traveling time in Austin is 11 to 2. That's it, because it's a bit traffic and all that.
Yeah, it's interesting. I actually started my own IT business 2008. So I didn't even have a W-2 job since 2008.
Okay.
But I got in a situation where, any project that came up and any unrealistic time frame that was out there, I would do it. I would make the dates. So that's what allowed me to get more and more projects. I had a number of Fortune 100 companies as customers. But so even though I had my own business back then, I still didn't have the luxury of time. I was always always going somewhere, always doing projects, and I'd sleep 3 hours a night, like consistently. That's all I would sleep.
So did you make, I mean, now you don't have to go by numbers, but did you make like almost similar amount of money compared to what you made in real estate? I mean, it's a time versus a money investment, right?
It's a great question, because when I first started looking at syndication, I said, I'm not going to be able to replace my IT income. And I truly, it was a mindset. It really was. I really did not think I'd replace my IT income. It was pretty high at the time. And after 3 projects that I did in multifamily, I stopped doing IT. I had not replaced my IT income at that point in time, but it was enough to live and live, decent. And then we've done 37 projects or whatever now. But I didn't think I was going to replace it, but yeah, we've far surpassed it. I mean, a lot, frankly. And the time we have, and I don't have to ask anyone to go anywhere or, things like that. You can turn it on and off if you want to. Where IT, if you're not working, you're not making any money. You don't have that passive income.
So you have a very interesting life cycle, because you were working in IT as a W-2 job. And then you went to do your own business, but still as an IT, right?
Right.
And now you are completely full-time real estate investor. So in terms of time-wise, I mean, from what we're discussing, I mean, real estate investment gives you the best return of time, right? I mean, you get really good pay. At the same time, your time is like really low.
There's no comparison. You mentioned about talking to your wife about how your life is different. I mean, my life is, 180 degrees different for the better than what it was before. I was in the verge of, I'm not sure, my wife wasn't really happy because of my work schedule. And now we get to work full time together, just like you get to work with your wife, which is great.
Absolutely.
And the time, if I want to go somewhere, and you can get to the point with multifamily or any real estate investment, you get enough of it. If you choose to go sit on the beach, which I don't want to do, frankly, I don't. But if you choose to go do that, you get in position to do that for sure. With IT, I wouldn't be able to. I had to keep working projects in order to make the money.
Yeah. But can we go back to your mindset when you are working, not as a business owner, when you are working in IT? Because I sometimes analyze my own mindset when I was working. Because when I was working, I did look at Robert Kiyosaki's book, and I could not read like a few pages because it just doesn't make sense to me. We are so busy working. And what is this guy talking about business, right? And after a few pages, I put it down and I forgot about it, right? So until recently, I started reading it. And I was just surprised that book changed a lot of people, real estate investors' life. I think when you are working, you're really, really working. You really don't care about business side of it. And I think it's up to your circle, right? Who are you mixing with? Who's your network?
That's a great point. I know when, I worked originally at KPMG Consulting, and I worked for SAP, did some Salesforce consulting, things like that. And you look at other people that are older than you at the time I started out, it was, early 20s when I started now, and look at other people that are partners, for example, and you have this image, you're like, that's my lifestyle. I'm gonna be traveling all the time. I'm gonna be working 7 days a week, which is what I did. And and then some point in time, not everyone gets to the point where it's where I was, but my point was, hey, and my wife was pretty much ready to leave me if I didn't do anything. And that was a big eye opener for me. But you're right. You get trapped in that circle of influence, right? And everyone's doing the same thing. And at that time, I aspired to be a partner, and I would have made partner. I mean, made a manager in 2 years and things like that. But I would have been miserable, frankly. I would have been.
So compared to the job security, I mean, I don't know whether there's job security in any job or not, because there is no job security, right? I mean, I when I was a manager, I used to hire and fire people very quickly just because non-performance, right? So there is no job security, right? I mean, I used to work on a semiconductor industry for like almost 20 years, and we thought we were going to retire there. But we realized, during different economic cycle, the company doesn't really, honor your loyalty, right? I mean, there's no such thing, right? I mean, they have to make a business decision. They'll let you go if they need to let you go. So there's no such thing as a company is going to be keeping you forever.
Right. It's true.
So coming back to real estate venture, right? So this was like 2000. 2008 is when so 2008 is when you got into IT. And when did you start your real estate venture?
Syndication, 2013 is when I first started investing passively and invested in a few deals. And about that time, I started looking at syndication, but it took me almost a year to get my first deal. Okay. And it was partly, I was looking at other things too, self-storage and building custom development, homes and things like that, franchises. I looked at everything. I was looking for something to get me out of what the bad situation I was in. But it took us about a year to get our first deal.
So did you stop work and start into real estate? Was it a step function, or was it like a slowly?
It's gradual. For me, it took me 3 deals. So I'm thinking, 2014 is when I think I got my first deal. I remember exactly, but by 16, I had stopped doing IT.
Got it. Was that a painful transition from a a business owner to a real estate investor?
No, it really wasn't for me anyways. I've always had a big fear of money, and I wish I didn't, but I always did because growing up and things like that. But we had enough money set aside to where, I looked at it. If I had to go back and do IT, I had so many connections at the time I could get a job pretty much, right away. I didn't want to, but I was like, okay, well, I have a transition I'm making here, but if I fail, that was my mind. If I failed at doing this, and after taking a year to find my first deal, I was pretty skeptical. And then we started getting the traction. So I was like, hey, if I need to go back, I can do that. I don't want to do it, but if I do, I can support the family. The transition wasn't that hard for me. We were buying at that time only in Dallas. So I really wasn't having to travel outside of Dallas. So it's pretty easy transition.
Got it. So as I was talking about that, you had like 3 different life cycle, right? You're a W-2 employee, you're a business owner, and then you become a real estate investor. So, and you are a CPA. So I'm going to ask you a similar to CPA question. How was your tax advantages comparing these 3 life cycles?
Okay. So, even though I'm a CPA, I haven't practiced for, 20.
But at a high level, right? I mean, was there a tax benefit between W2?
Without a doubt. Yeah. So when I had IT business, I was actually paying taxes quarterly. I was getting hit hard. I mean, I was making decent money. Now, the last 2 years, we haven't paid any federal income tax, like 0.
Okay.
And in fact, it's negative. So people are like, oh, you didn't make any money. No, we make money. But from the tax benefit we receive through depreciation and cost segregation and bonus depreciation, we pay 0 federal income tax. So, I mean, just think about people listening to this. If you didn't have to pay taxes, how much more money you'd have in your pocket.
Absolutely.
And what you could do with that.
Yeah. I have a chart that shows how a $2 double for next 20 years. And, at a 25% rate, that $2 become like 72,000 after 20 years because you're being taxed 25% every time you double.
Right.
But if you don't have tax, that $2 becomes almost like $11 million.
Oh boy. Oh my goodness.
So the tax does impact your compounding savings, right? And if you don't really look at it, you may not know. I mean, when I was working, I never really look at tax because, as I say, we are busy working. We just look at net pay coming to the thing. I mean, tax is like, it's a noise for me. But when I look at that kind of chart, it does make a lot of difference in terms of, hey, it does impact your overall savings. If you compound it for 10, 20,
right,
see a big difference, millions of dollars of difference.
And like you mentioned, when you have a W-2 job, it just comes out. You notice it, you don't like it, but when you have your own business, my own IT business, you have to write a check every quarter. You really notice it, and then you're like, I made that much money this quarter, and where did it all go? And now I have to write a check for, X number of dollars, and, you're just scratching your head and you're frustrated and stressed out. But with real estate, it's literally 0.
So did you have employees under you when you have a business?
All 1099, never any
1099. Okay. So if you have an employee, then you have to pay tax for them too, I guess, right? So that's a double taxation when you have a
That's business. Exactly right.
Okay. So W-2, I mean, I don't know. I have a chart that shows W-2 people are paying almost 70% of the tax in this country. So this country is supported by W-2 people who are in W-2. They are the ones who's paying the taxes. They're the ones building the roads, the bridges, and all the infrastructure, right? The 30% is from the other people who are people who are earning less than 30,000 or people who are earning more than 500,000 and above are paying
Right.
much less number
Yeah.
of taxes, I guess, right? I mean, no, people who are earning more than 200,000 do pay a lot of taxes, but in general, if you look at it, the big bulk of it is paid by W-2 employees.
Right. Because the number, yeah, makes sense.
It's because you can't run away, right?
Right, you can't. There's no way. There's no savings, no tax shelters.
Absolutely. Real estate investors all have all kind of incentive in the tax code to get not paying taxes. So coming back to your real estate venture in multifamily, and you skipped over buying single family and you went direct to multifamily. Is that right?
We did. I mean, multifamily, 2 to 4 units when I was 22.
Okay, so you did something. Okay.
Yeah, so it was smaller for sure. It made more sense to me, frankly. I don't remember. I actually didn't look at any homes. I don't know why. I go back and think about that. Why I didn't start looking at any single family homes. To me, we looked at 2 to 4 units at the time.
Well, I mean, if you look at cash flow, 2 to 4 units definitely makes a lot more sense in terms of cash flow, right?
It does.
Maybe that's what it is. And how many 2 to 4 units did you own before you come to multifamily?
We had like 17 units total.
Okay, 17 doors in 2 to 4 units, I guess, smaller multifamilies. Yeah. And do you think that helped you when you scale up?
It did. It did, because I mean, even I know you manage, right? You and your wife manage, and when we did the smaller properties, we self-managed and we took care of things and evicted people. So it definitely helped from that perspective. I didn't like the process, so it's not something I want to do now. But it also, even though it's drastically different how you evaluate 4 units and below, and in 5 units and below is drastically different. The steps people can argue them all day long. The steps are almost identical, right? You identify your criteria, you go drive by a property, you contract, blah, blah, blah. Everything's the same. So it helped for sure. Plus just kind of, getting comfortable with buying your first deal is the hardest. So once you start, I bought like whatever it was, 5 deals, 6 deals. I remember the number was exactly. And it gets you more comfortable. So when you go buy a larger property, it's bigger numbers. So it is concerning. But I had already done, like 6 transactions before that time, even though they're small.
Got it. Yeah. I mean, just in a way, it helps because, I mean, you know the lease, how to read the lease, and you probably know how the real estate transaction happens, right? Which is
your first time signing for your first deal. Usually, you're most likely going to be pretty freaked out, right? When you've done 6 smaller deals, it's still. Then when you start doing a bigger deal, then it's the money, right? The only thing that concerned me, I should say, only really was the bringing capital to the deals. I had no concerns about how to underwrite the deals, because I knew how to do that, or how to find deals or talk to brokers or loan. It was always about, the capital. That was my biggest concern.
Okay. But do you think that's still an issue in this market cycle?
The capital?
Yeah.
Yeah, I'm always concerned about capital. We have like 8 deals under contract right now. Like, so we've never not closed a deal. But, it does. That's the one thing that still stresses me out sometimes, frankly.
Yeah, because you need to figure out whether you have enough, big enough investor base to run all those 8 deals, right?
That's right.
Okay, got it. So coming back to the multiple markets that you have, do you want to explain on how did you get into these so many markets? I mean, I think some of it is you partnered with some of your students.
Well, originally, I was just buying pretty much with one other person in Dallas. Dallas, at least in my opinion, was definitely getting more expensive, and it's even more expensive now. And I have a twin brother that moved to Atlanta, so I used to visit him. And Atlanta has a lot of similarities to Dallas. It's not where Dallas is yet, and it may never be, but definitely has a lot of similarities. So I started traveling there. I looked at properties for about a year and a half before we got our first deal, and I just really liked the market. Because that kind of was through. If my brother wasn't there, I don't know if I would be in Atlanta. Frankly, I don't know if I would have thought about going there. When I'm going there, I see a lot of activity, new building, new development, cranes, things like that. So it was an attractive market. And then so that's Texas and kind of the Atlanta area. And then when we started looking in the Southeast, just as a general statement, some of the brokers cross different states sometimes too. They might. If they have a license, they can actually sell in multiple states. So they might say, hey, we're in Tennessee. We have a project here. We have a project up in Arkansas now, which we don't own anything there yet. So these brokers started giving us deals, and I started checking out different markets. And the really the way I got into these other markets, as far as initially, was I would have brokers in Dallas typically reach out to other brokers in other markets and make an introduction for me, and that kind of gives you instant credibility, and they're going to typically give you the best of the best of brokers to work with in another market, and that's how we got involved in other markets.
Got it. Got it. Got it. So, but how did you choose this market? I mean, except for the Atlanta, where you said your brother was there, you initially went there because of Atlanta, but now you are like in 5 different markets.
Yeah.
Tennessee, Alabama, Florida. How did you choose these markets? Why these markets?
A friend of mine who I've done a lot of deals with, well, he had bought a smaller deal in Memphis, and I never would have considered Memphis. And some people don't like Memphis. We own a lot there. We've done really well there. But Memphis also has, even though you want the job growth, population growth, things like that, it's okay, but not like Dallas, of course. But the rent growth has been going up. They're putting, several $1 billion in investments of downtown. But that particular city also has something called a pilot program, which we've done multiple times, where you can go in, you buy a multifamily property, you have to put a certain amount of capital into it. It's a lot. And then you'll get your property taxes cut in half, and then they're frozen for 20 years. So, I mean, as you know, property tax is typically one of the largest, right?
Absolutely.
So if you have to freeze them for 20 years, cash flow is going to typically be pretty nice on it.
So do you? Yeah, that's so you're basically taking advantage of that particular program. What about the other states that you?
Yeah, Florida. I liked Florida just because of probably the weather initially. And when we were in Atlanta, we started looking in Florida as well. Florida has, some areas like Miami that, as you probably know, are extremely expensive. Just not going to buy there. But I also have multiple cousins actually, that live in Florida, and so I heard different things from talking to them, and then some of the brokers we were talking to, like in Georgia and stuff like that, had some properties in Florida, and a property came up. And first time we were looking at properties there, really liked the property. It's in Jacksonville. We have a few properties there now, and it was one of those markets again, similar to Atlanta, where job growth, population growth, rent growth. And it doesn't have to be off the charts. Frankly, some of the markets where it's so off the charts, it's just too expensive to buy in. The yields, you can't get the returns. And then with Alabama, it was a guy that had a deal and was looking to partner. I partnered with him on a few deals. He had deals there in Alabama. And then we have another one right now a guy in our coaching group that has a deal in Alabama as well. He's closer over by there as far as that's where he's been looking. So usually it's through some sort of relationship. Okay. Somebody either already lives there or someone is looking there, and then it kind of gives me an opportunity to check the markets out.
Got it. So basically, if you have a boots on the ground as part of your program, that's an advantage, definitely, right?
It is for sure.
There. But don't you find, establishing broker relationship in that kind of market is harder? They do not know you, right? Or
it is. There's no question. I think that's why it took us so long to get into Atlanta. We had a really hard time breaking in there. And then once we got in there, there's one brokerage firm in Atlanta that we closed 11 deals in like 18 months with. So we definitely have their attention. But it's that first deal. And went to Florida. We were just banging my head against the wall because we couldn't get any traction with brokers there. I would say, you just keep sticking with it, but there's no question, if you're an outsider, don't live there, and you've never bought a deal there, you're at a disadvantage. You can use things like, hey, your track record, and you can have brokers that I know. So when we got a deal in Florida, our first deal, it was with a brokerage firm that I had bought a deal in Dallas with, and the broker in Dallas had called me about it. So he, if you want to say, put a good word in for us. So a lot of these brokers talk, as you know, it's a very small world.
Yeah.
And I don't think we would have gotten that deal in Florida if I had not bought a deal with that broker, brokerage firm, if you want to say, in Dallas. I think we would have probably not been selected for that deal.
Got it. So let's go a bit more detail into the step by step. So let's say today somebody, in your circle or one of your students comes, hey, I found a deal in Florida, right? Somewhere in Florida, right? So what are the things that you would do to underwrite the deal?
the underwriting, different aspects of it, forget the reports and stuff for a second, but, even, financing terms can be drastically different across the country. Some of the pre-review cities and stuff like that start at 65%. So you want to first understand, don't assume you're going to get 80% leverage and 3 or 5 years IO in every single location because it's different. So understanding first from that, insurance can be drastically different. If you're on a coastal area, it can be a lot higher than other areas. So understanding kind of the fundamentals there. Taxes, do they get reassessed? And that can be through, we have a tax consultant we use, but also you can typically just call the county, and the county will tell you kind of how the taxes will be reassessed and when. In Memphis, it's every 4 years. So that's important to know. They only reassess every 4 years. And then we'll get like a report, whether it's Yardi or CoStar. Those are paid reports. We'll also use things like there's some, we have a number of links on our analyzer to take you to things like for crime and the school districts, things like that. Those are all links we have on that. But overall, nothing beats having someone on the ground. So if you can talk to other people there and talking to lenders, lenders have the biggest investment in a deal than anybody, is a general statement, right? They have more money involved. So trying to understand from lenders too, kind of how some of the properties are performing there is important. In report, like I said, is only as good as a report. It is good data. A lot of it's based on, actual transactions that have happened, but trying to get someone like a broker or a property management company. So if we have a property management company, David Shore is multi-south in Memphis, and he's actually in 7 other states. Once we built that relationship, then we start asking him questions. He'll tell us, don't even look at that deal. It's not a good deal. This deal maybe you look at, 95% of the deals tell us not to look at there. So having some boots on the ground can't be replaced. It might take you a while to do that. It's typically going to be like a management company, or maybe a broker, but brokers in to sell. They're in, they don't get paid unless they sell property. So kind of all the different aspects, reports, talking to people, visiting the area, trying to understand what happened before in the past. Those areas are all good ways to kind of get more intel on the property.
So you basically look at location, crimes, making sure how are you underwriting your tax? Because tax, you're right.
Tax is huge, right?
Every states are different, right? So
every state, county, city, even sometimes. So we tell people we have a tax consultant, but we have found really if you call the county and tell them the property what you're doing, they'll tell you how they're reassessed and they'll give you a good number. We've only had like a couple of occasions where it hasn't really given us the information we want. Generally speaking, we always get the information we need from the county.
Got it. So who have told you the most no's? Who said don't touch that deal the most of the time? Is it property management company, or is it a tax consultant or insurance company, or
property management company?
They say don't touch it.
Us, no, without a doubt, property management company. And maybe they don't want to manage them, right?
But how do you know they are just don't like that property? Maybe that's just because.
Yeah, it's too. I know you self-manage, but what we have found is almost every submarket we're in with a management company, even if they don't manage a property today, they're like, we managed that property 5 years ago. And, you might have some intel. We had a property here where a number of properties in Dallas I've looked at, and our management company manages it. So I call the guy and say, hey, what's up with that? And he'll say, it has like $200,000 of plumbing issues or whatever it might be. So, but usually someone that's large in a submarket, they know the property, or they at least know it, the area well enough to give you some really good intel. And I don't know, it seems never seems to amaze me where people are like, well, management company says we can push rents to like $75. I think we can do it like by $125. It's like there's no basis for that. Like, why do you think you can do that? You need to rely. You can push your management company and ask them questions and things like that. If I go try to do a comp for a property myself, I don't fit the demographics, I'm probably not going to get a good comp. Have a management company do it for you. They'll actually send people out there that fit the demographics. They'll actually get you comps and pictures and things like that. Go into some of these reports. I get called all the time from these, I won't name them, but these providers of data call me all the time. I don't talk to them. I don't have the bandwidth to do it. And you do, right? And half the time the information you get, you don't even know if it's right. So it's coming through there. So Yeah.
So how do you know the management company that you're calling is not the current management company? Because you don't know.
Yeah.
Right? Because
It's happened before. You can ask the broker who manages it today. They'll tell you. Because as strange as property could be for sale and the property management company doesn't even know it.
Yeah.
And if you call them and tell them, hey, I'm looking at this property for sale, then they're going to be pretty upset.
Yeah. I've looked at out of state as well at one point, and I realized management company gives me the best data, best quick data. They can tell me a lot of things about a state compared to anybody else, right? Because they know the pain of managing it.
They do.
So I would say they are one of the best resources to call if you're looking at out of state investment, right? So after that, what do you do? I mean, you already looked at taxes, you already looked at property, so it's all good. So what do you do next?
So then we'll underwrite it usually using we have a quick analyzer, we have a much more detailed analyzer, and the detailed analyzer, we're going to go through every expense category, like line by line, compare them to the T12. We try to get 2 independent property management budgets, so we get that, and then our analyzer also has industry standards based on property class and size. We'll tell you what the standards are for every single category, which is very helpful to see if something's out of whack. I just had an example. Somebody not in our group, someone sent me something. It was 2 properties. It was over 300 doors together, and they had payroll at $750 a door. I'm like, no, it's not going to happen. Oh, we're going to share the property manager on site across the 2 properties. I'm like, not for 300 plus units. You're not going to. Not very easily. So I said, okay. So did the management company say they're okay with that? No. And even if they did, what happens if you have to get rid of them? And now you're going to bring in another management company. They're going to be at $1,200 a door. Correct. So it just happened another one today, actually, on something where they're getting charged 2.5% on 80 doors. I said, that's pretty low, 2.5%. Not saying it's impossible, but you need to probably bump that up, because just because one management company said they'll do it for that, if they're not your management company anymore, then you're going to be paying more typically. Yeah.
You can underwrite just because of one person said it, right? I mean,
that's right.
2.5 is really low compared to any industry.
80 doors, it is.
Whenever I see sponsors or syndicators showing me a deal, I mean, not many people show me their deals, but I do get to see some people's deal, right? I mean, when they say they want to share management, that is an indication that that deal doesn't have much upside.
It doesn't work.
They have to do really, really creative, weird stuff. They have to share this, we have to share that, we have to do miscellaneous income, we have to do covered parking, we have to do wash and dry rental. That's all like really, really small amount of upside, right? And basically that deal is not a good deal, right? I mean,
that's just the gravy. You're exactly right. I mean, it, right? You manage your properties, and when people are like, "I'm going to share," it's like you're not going to. I mean, if you think it was that easy, don't you think all the management companies would do it?
Yeah.
Right. I mean,
you're gonna compromise a lot of things when you share management. And as I said, when you're going to that extent to really justify your upside in the deal, that means the deal is really not a good deal, right? I mean,
well, James, I have people that be like, "We're going to put in Wi-Fi and charge this," and they're trying to put that in underwriting. I'm like,
what's the point?
First of all, you might not be able to because of the cable contract, right? You might be allowed to, and second of all, let's just assume you're able to do that. Is that needed in your analysis to make the deal work? I sure hope it does. It doesn't need it.
Yeah, absolutely.
Crazy.
For those who are learning this business, the biggest bulk, the deals that work is when you can bump up rent and you can reduce expenses. If you can do this thing, this is the big thing. So if you see any deals that you can, majority of your upside comes from here. Don't look at adding more 1 or 2 washer dryer, adding covered parking, adding Wi-Fi, as what you said, or sharing management. That's all right. Really, the deals doesn't work at all. I mean, the sponsor is just trying to squeeze all kind of juice and tell you that it's going to work, but in reality, it's really, really hard to make all that work. I mean, all that's a bonus. If it works, it's good. If it doesn't, work,
that's exactly right.
Right. So,
and your total expenses, you could go up because of property taxes, but some of your points around you reduce the expenses. I mean, there are huge savings on water lots of times for properties, right? You can go in there. Repair and maintenance, we see lots of times you do as well, I'm sure, where people are putting capital items in repair and maintenance, and they're like, $1,400 a door per year. I mean, that's really high, right?
Yeah.
So they're just putting stuff up there. If you go in and get a loan, able to put capital in there, maybe do roofing, some ACs and things like that, you can most likely bring your repair and maintenance down more to industry standard. So for looking for those things, but if you don't know what those standards are, you don't have any gauge.
Sure. So we don't have to talk about your detailed analysis that you do, but on the sniff test that you have a quick analysis, right? So what are the few things that you would look at to, kick out a project?
Return wise, I'll look at, we still shoot for like a 10% cash and cash return, which is getting harder in a lot of markets.
10% with the IO on year one, I guess, right?
Yeah. With overall of the product, it's a 5-year project.
Oh, 5-year project.
Still want
got it.
Yeah, like a 10% cash and cash, a 15% plus IRR, and 100%. 100% is getting harder on 5 years, frankly, for a lot of properties, closer to 6. In some markets, it's more than that, but usually we try to stay in 6 and below to double the money. And then I look at other things like, what cap rate are they using, they're on the exit, how they get the current cap rate. Oh, the broker, I had someone, no joke, in Florida called me and said, and it wasn't Miami, by the way. And they said, oh, the broker told me the cap rate's 3.5. I'm like, no, it's not. You know what I mean? What? So those type of things, right? So you can make any deal work, right?
I know.
That's on a piece of paper.
Just change the exit cap rate and you
exactly right. I have an example I do in our workshop where I'm like, this, and then you do the cap rate down to 2, and what does it do? And then other things are going to be more around total income growth over the first couple of years. What does it look like? I'll see sometimes people think we're going to grow income 30%. I'm not saying it's impossible to do that, but when I see a property that's 92% occupied, you're going to go up 30% in your total income in a year. It's pretty high.
Yeah,
I'm not, so you need to have a justification for that. So basically, we look at a lot of different gauges: break-even occupancy, break-even rents, things like that, and then the financing. People don't understand financing well enough lots of times as far as how they're going to do that.
It can make or break a deal, right? So let's look at like the rent growth and the exit cap rate, right? So how do you differentiate this rent growth and exit cap rate on these like 5 different markets that you have?
Yeah. Well, the market cap rate. So we always start with the sub-market cap rate. Doesn't matter which property it is, and we have different ways to get that through reports and things like that. And then we put an escalator on it, an annual escalator, and it'll be different between A, B, C assets, and we have some ranges there. Some markets actually, Dallas has gotten compressed so much on Class C. It was like 8.5% and 13. Now it's like 5 cap for a lot of properties, right? And you don't know is ever going to go back. So we'll usually use minimum 0.1 up to 0.2 per year. So it could be a full 100 basis points on a 5-year exit. And a lot of it's depending on the property and location. Some of the markets that the cap rates have been compressed there, but they haven't compressed as much as like Dallas. They might have been, let's just make an example, say Dallas 8.5, now it's 5. And the market there might have been 7.5, and now it's 6. So it went down, 1.5% total. But we'll look at the property, the type of property, the age of it, asset class, and then the demographics, and we'll add an escalator on an annual basis for it.
Okay.
So each year it escalates up.
But how do you decide that? Like, so for example, I think in Texas, a lot of people use 3% rent growth, right? Even though some cities are different.
Well, no, it's for rent growth. Yeah. So rent growth, we usually use 2% just across the board.
Across the board, across all
markets.
All your deals.
After year 2. Your first 2 years, as you know, right, you might have come in and you're increasing rents. We phase revenue in and things like that. After year 2, the general statement is going to be a 2% rent increase.
What about expenses?
2.
Okay, so 2% income growth, 2% on year 2 onwards, I guess.
Right.
Yeah, which makes a lot of sense. You're not really counting for the first year for value add, and it's just
right. You might be higher. Some people were like in Dallas, 7.5% rent increase growth for a while, and people are like, I'm like, but that's like today, one point in time, is you think is proved where it's Dallas rent increases have gone down considerably. Still a great market. I like the market. I don't really buy here right now, but you can't count on today. Or someone will say, "Hey, the economic vacancy, is 6%." I'm like, "Yeah, but good for them, but you can't count on that."
You can't count on that. Yeah. So yeah, I mean, even I looked at, yesterday there was a national multifamily trend report which shows Dallas is below national average in terms of rent growth. In fact, San Antonio and Austin has been always higher than national rent growth, but even San Antonio is higher than national rent growth, which I never seen that San Antonio being higher than Dallas. I mean, it's just cities change. You have to be really conservative in your underwriting as well.
I think people are like, enough is enough, right? When rents go up, 7+% for a few years in a row.
Yeah.
People are like, and it doesn't mean it's a bad market. I mean, there's 150,000 people a year here that move to, or net.
Yeah.
So there's great job and population growth.
Got it.
I've been arguing that for a while. It doesn't matter. All those things happen. At some point in time, people will say enough is enough.
Yeah, people can't pay anymore.
Yeah, when they get a 2% increase in their wage or whatever they get, in 7% on rent, for years in a row, it has a big impact on them.
Absolutely. But how do you, like, for example, in your experience, because you're working on multiple markets, right? Apart from Texas, which has been seeing a good rent growth, do you see? I mean, I think even Florida is seeing a good rent growth, right? Like Jacksonville, Tampa, Florida. I'm not aware of other I do not know about other markets. How's this Tennessee, Alabama, and I think even Atlanta.
Georgia's good.
Yeah.
As a whole. I mean, some markets, and we bought in a place called Gainesville, Georgia, not Florida, but Georgia. Property's done phenomenal, but it's, that's a secondary market for sure. It's about 45 minutes from Atlanta, but it's like, a 7% rent growth right now. Same with Dalton, Northeast, almost close to Chattanooga. Rent growth, some of these submarkets. And so that's, Florida, like you said, is high. Georgia, parts of Georgia is definitely high. Alabama and Tennessee, I would say, are mediocre, frankly. They're just going to be average. Nothing. Now, Memphis, in general, the rent amounts are lower, but the rent growth there is quite high right now from a percentage standpoint.
Got it.
But, they're starting with rents half of Dallas, wherever it is, right? So it's proportional. But the percent of rent growth in Memphis is actually quite high right now. I think it was, last I saw, it was in the top 10 in the country.
Oh, really? Okay. And what about the exit cap rate, right? So usually, I mean, the usual underwriters, people use like 1 to 0.5% more than what the market is. Do you use the same exit cap rates in the other markets?
We take the current and we'll add. So let's say the current was a 6 cap. We'll add 0.1 per year to 0.20 per year. And in some cases, like to your point, and so the end of 5 years, you would have gone from a 6 to a 7.
Okay.
And in some markets, we'll be, if we're going to be doing a 0.15 in a certain market, and we're like, well, maybe this market isn't quite as attractive, or in the past it hasn't performed quite as well, we might do the 0.20. End of the day, I mean, as you know, nobody knows what cap rate's going to do. We can all guess.
No one knows. Yeah, correct.
And the important thing to consider is that, cap rate has no impact on your cash flow per se. It's really more of a capital event, like a refi or a sale, things like that. So if you can still cash flow and, get a return, then, you wait to sell till the time it makes more sense to sell.
Correct. What about loan-wise? Are you guys been doing, long-term agency debt, or you've been doing some short-term loans as well?
We do about a third of the deals we do probably a bridge. They're not necessarily short-term. It's still up to 5 years.
Okay.
So it's not short-term really. And the rates are attractive. And there's, a lot of advantages to bridge and some disadvantages, but there are a lot of advantages. I like them, especially in the big value-add deals. You pretty much have to get them. And then we do Fannie, Freddie, and then a number of bridge, frankly.
You work with a lot of, students who are trying to come up in this industry, right? So can you describe one characteristics of a student who made them really successful, sponsor on their own?
His characteristic is, if you want to say grit, right? Not giving up. But as far as a whole, it's getting really good at something, not really, one skill set. You don't have to know everything about multifamily necessarily to get started. You have other people there to help you. But getting really good at something that's of value to somebody else. And it sounds like, okay, that's kind of obvious. Well, we've seen it work time and time again where someone, all they do is, we pretty much come in and just find deals. That's where their specialty is. They don't want to raise money or sign the loan or, things like that. But I think it's being patient. when you have to wait a year potentially, I waited a year to get my first deal. That's a long time, to wait. And then you look at it back on, it's like, that's not a long time to wait when you start buying more and more deals. But when you're like trying to do something new and you're spending 12 months before you get a deal, that can be frustrating. So say being patient.
Yeah, especially when people already committed, I'm going to do this
Right.
Yeah.
Some people give something up to do it.
Yeah. I mean, everybody just remember there's not much deals out there, right? So,
Right.
finding that one deal that makes sense takes time and takes perseverance and grades, as what you're saying, right? It's not easy.
Right.
Easy, everybody will do it.
That's right. Right.
So coming back to your personal side of it, is there any proud moment in your life that you think I would remember that moment until the end? At one particular moment in your experience in your real estate venture?
That's a great question, actually. I would say when I got that third deal and it closed, because I had already decided if I closed that deal, I was going to stop doing IT.
Okay.
So when I got that third deal and said, hey, my son kept asking me, because I kept looking for deals. He's like, if you get that deal, can you stop doing IT? Because he was seeing me work so much, right? And so when I got that was huge for me for family.
Got it. So that was a transition point of you getting away from IT to real estate, I guess, right? So,
right. And making the decision, like you said, to do it full time.
Yeah. It's a hard decision, especially if you're already used to a certain industry, right? And that's what has been giving you paying your bills, right? And now you're
paying your bills, which is great. And the other thing, unfortunately, when I was doing IT, that was kind of my self-worth. That's where I got my value. I was, tell people I wasn't really good at a lot of things, but for some reason my mind just worked that way. And so I got my, my self-worth out of my job. So to give that up, is a big thing, right? And you don't know if you're going to get how successful you're going to be or not in your new adventure. But I mean, best decision ever made.
Yeah, I mean, you brought up a good point. Sometimes that whole industry, what you study for, defined you, for 20, 30 years in your life, and suddenly you are changing your complete identity. I mean, it's a big thing, right? I mean, a lot of people do not want to do that. If they're known as engineer, if they're known as CPA,
right,
IT guy, they don't want to know what is suddenly this guy's doing real estate, right?
Oh yeah. I mean, even my CPA said, "What are you doing?" He did. Now he doesn't say that anymore. He doesn't. Yeah. He did. He said, "What are you doing? Why are you giving up? Why are you stop? You're making all that money doing IT. Why are you not doing it anymore?" I mean, he couldn't comprehend it.
Yeah. And I have to mention this. When I was in IT, when I was an engineer, I always think that people in IT, people in engineering are really smart guys. So these are the smartest guys, because that's what your circle is, right? Your circle of friends is there. You think this guy is smart, solving problems. And when I did my MBA, it was really eye-opening because I realized there's a lot more smarter guys than me who's a lot more money in the financial industry. Oh my God, I was thinking. So that was a big aha moment. And that's where I realized that, you have to go into business to make a lot more money, right?
You do.
And there are a lot of other smarter guys and other smarter professions out there that makes a lot more money and just more advanced, I guess, right? So I mean, before I forget, what is the most valuable value add that you've seen in all your deals? What would you do in case your rehab budget got cut into half in a deal?
Oh, I mean, from a CapEx?
CapEx wise, yes.
One, people need to be, if the property looks like junk outside. I've been in properties that look good on the outside and they're not that great on the inside, right? But you need something outside to kind of attract it. And it could just be paint, something so it's not dreary and dark colors, but using something a little bit more attractive color wise for paint, landscaping, simple stuff to do. It's basically, if you think about what does a tenant see? When people say I'm going to do, electrical work and things like that, it's like the tenant plumbing, those stuff might be done, but tenants don't see that. So first, start with the outside and see what the tenants. Whether they go up to the office and it's kind of decked out. Sometimes we'll spend a lot of money around the office to kind of put a lot of landscaping there and make it really nice. Exterior wise, interior, paint is pretty easy to do. Flooring is huge, just from a maintenance standpoint. So if you can do it, but as you know, it's not really that cheap to do floor. And then we'll resurface countertops. I wouldn't do cabinets and stuff like that if you don't have the budget for it. I wouldn't do appliances unless they need them. You're not going to get the bang for the buck for that. Again, people will see the paint, they'll see flooring, and they'll see like, maybe resurface countertops and paint the cabinets, things like that. But some people have really high aspirations. They want to do all these things, but at the end of the day, you're not living in the property. So don't outdo the market unless someone, I don't want to be the first guy to prove something in the market. I'd rather have other people prove it first. But I would say for sure, start with the outside and start like with landscaping and paint, stuff like that. People can see that.
Awesome, Mark. So we're at the end of the podcast. You want to tell our audience and listeners on how to get hold of you?
Yes. Email address is Mark, M-A-R-K @thinkmultifamily.com, and love to chat with anybody. And I really, really appreciate you spending time with me today, James.
Sure. Absolutely. Thanks for coming over. You had a lot of value. I really like going across markets here, because sometimes it's hard to find someone who have done deals in different markets, right? Because it's important. A lot of people want to do markets everywhere.
Right.
So, there are deals everywhere, right? So you just have to buy it right, and you have to analyze it right, and just make sure the numbers work and the location works, right? So
that's right.
Yeah. Awesome. Thank you, Mark.
All right, James. Appreciate your time.
Absolutely.
Take care.
Bye.
Bye.
That's it for this episode. If you'd like to learn even more, check out James's free audiobook. It's the audio version of his best-selling book on passive investing. You can get the audiobook completely free, along with other valuable resources, by visiting www.achieveinvestmentgroup.com/free audiobook. Also, be sure to join our Facebook group too. To find it, just do a Facebook search for Multifamily Investors Group. Thanks for listening. Join us again for another episode next week. See you then.